Good afternoon. It is Monday, November 12th, 2 p.m. My name is Stock Darts, and today we have a video looking at a potential covered call play that could be setting up on a couple of utilities, specifically utilities that have been hit pretty hard because of the wildfires in California. This is going to be a play that specifically is going to more often than not be included in my patreon.com/stockdarts options tier subscription. It's a new tier that we just launched this month, and if you're interested in that, go ahead and feel free to check the link below in the description for my Patreon page. If you're watching this on YouTube, if you like this sort of content, if you want to see more videos from me, feel free to hit the like button or subscribe, and you'll be notified immediately whenever I go ahead and make new trades. It's something that I'm planning on doing a little bit more, is providing more video content as we close out this year. And hopefully it helps you guys as traders to find other trades, and more specifically to see how I look at trades and how I go ahead and try to find and structure trading opportunities, especially in markets like this where they may be more difficult to find and it may be harder to find good directional trades, but we can always find different ways of trying to find things that will work when the market is not really providing us with really good setups. So for starters, I went ahead and was going through screeners. There's a lot of utilities that are actually doing very well. Typically during times of market difficulties, utilities tend to actually perform decently because they're safer names. And as you can see, there's quite a few of them. If you could just go through the screen, there's quite a few that are trading at highs or making their way towards highs or breaking upwards through consolidation. But what caught my eye today was a couple that were really getting hit hard, which was PCG and EIX, right? And again, both of them specifically are based in California and are dealing with some issues based off of that, right? And what I saw here is an opportunity to possibly sell some premium, right? You have options, you have names that typically don't have a lot of volatility, that all of a sudden had an explosion in volatility, and is typically the case in these scenarios. It could give us good opportunities to go ahead and sell premium, and particularly in the case of something like utilities, it could set us up in a position to start a covered call position if we could get enough premium selling puts, or even if we just want to go ahead and start with stock and just go ahead and start selling calls immediately to take advantage of this inflated premium. So I'm going to go over a couple of different ways that we can try to take advantage of this situation and how we would want to go ahead and structure plays. I'm going to focus more specifically on PCG, but I think the ideas work on both. So what we're looking at here is there's a couple of different ways to go ahead and enter a position like this. And I do want to stress, for anyone that isn't interested in this sort of a play, you should probably have some experience selling options premium if you want to go ahead and take a play like this, particularly when you find yourself with a name that's sort of in a distressed position or under duress as far as the reason it's gapping down and the nature of the volatility. You can put yourself in a position, for instance, if you looked at this on a Friday and said, well, we gapped down, but we're at the bottom of a very nice range, you could have sold premium then and thought you were really good, and then today this thing opened and traded all the way down to 25. That's a huge $15 drop on a name, and it's come up quite a bit since then, almost $10 from the lows, but that is the danger that you put yourself in these types of trades. So you have to understand risk management, and you have to understand position management and how much you're willing to allocate to a position like this, and it should be something that you are comfortable with absorbing heavy losses if these gap downs continue. So that's the first thing I want to get out of the way, is make sure you understand the type of risk that you are putting yourself in these types of positions, because there is the potential for further downside, and while I think in these situations we're in good shape here, even someone that sold premium on Friday could be in good shape by the end of November and December, as if this thing comes right back to that level. But it is something that you need to keep an eye on, and it is something you need to be aware of. Alright, so with that being said, there are a couple of different ways we can go ahead and look at this. The first is if you just want to sell put premium, and that works pretty well. The issue with that, of course, is if this thing ramps all the way up to 40, all you're collecting is whatever you collected in your put sales, right? If we go ahead and we go to Thinkorswim, and we take a look at, say, December 21st, just before Christmas, and you look at the puts, right now, you're looking at anywhere between $2 to $3 and change, depending on how far down you want to go along these levels, right? Whether you want to go to 30, if you want to stay at the money around 34, 35, or if you want to be safe and go all the way down to 27.50. So you can pick up about $1 per spread, and or dollar per option. That's not bad, right? Picking up $100 on 100 shares, all the way down to 27.50 is a pretty safe play. But this thing has $6 of upside just to get back to where it gapped down from on Friday. So if you just sell premium, you could leave yourself missing out on a nicer potential play, assuming you don't get assigned those shares, right? If you sell those $30 puts and this thing trades down to 30, well, then you get assigned 100 shares, and then from there you go ahead and build your cover position. So one way to do it is to just sell puts, and if this thing continues downwards, well, then that's fine. You sell puts the next month and you continue until you build a position that you're comfortable with. The other way of doing it is to buy shares right now at about 34.50, 34.60, and sell puts. And then that way you have the potential to own shares in case this goes back up to 40 right away. Or if this thing trades down to 30, well, then you'll add to your position and lower your cost basis a little bit more as you get assigned. And then from there, you can go ahead and figure out how you want to go forward through it. I sort of prefer, typically, when I'm first starting a cover call position, to enter with shares and then sell puts on down days. But with the extreme volatility that we're seeing, even though it's actually shaping up pretty nicely as we're speaking, and it's actually starting to move upwards, so we're losing a little bit of that premium that maybe we had a couple of hours ago. I think overall, on a stock like this, I'd prefer to buy my shares and sell some puts. And then finally, the last thing you could do is, if you were really conservative and you just wanted to go ahead and try to pick up, say, 10% on this, and not even care about trying to get this to go back up to 40, you could buy some shares, sell some puts, and sell some calls already, right? And if you look at it, you can go ahead and sell, say, 36. You could probably get about $3 for that, and you're buying at 35, and you can go ahead and sell, say, 32.50 and pick up another $2.60, and right there you've got almost $6 in premium, right? And that's $6 in premium on a $30 name. That's actually close to 20% that you could be picking up just in a month by trading it that way. Now, of course, you're leaving a lot of profit off the table. If this thing trades up to 40, well, then you might be able to get more for those 40 calls. But that is one way of looking at it, and I would say it's actually a pretty good way of looking at it. You don't necessarily have to wait for this thing to move up to 40 to go ahead and try to sell calls. Now, of course, I'm getting ahead of myself. This thing may not get to 40. It might just go back down to 30. So that is the danger of taking a trade like this. But if you wanted to, like I said, there's a couple of ways of doing it. First, you can just go ahead and sell a put. Say we want to sell the 30 put, right? So sell. We just go ahead and sell a single put, right? And then you can go ahead and sell, say, a 36, right? And of course, right now I'm just clicking on the bid, right? So we're not getting good prices. But I would say if we just go to the mid on something like this, you can get maybe $1.80, and you could get maybe about $3.10, right? And then we went ahead and bought some shares, say 100 shares. And so here's what we're looking at with our risk profile. And the thing to take a look at here is what our cost basis is, right? So we bought the stock at $34.85, but our cost basis is actually a lot closer to 30. It's almost 30 on the dot, because we picked up $4.90 a premium. And so we actually aren't losing on this trade unless this thing starts to go back below 30. And at that point, of course, you're in the hole for 200 shares now instead of 100. So you want to keep that in mind, because if we get a gap down to, say, 20, you could be down $2,000 on this trade that you were hoping to just pick up maybe almost $500 on, right? So you have to make sure that you understand where you stand with this and what you can afford. But this is a good way to go ahead and just lock in, roughly, what is that? That's roughly $5 on a $35 name, right? So we just go ahead and put out our calculator and divide 5 by 35. You get 14%, right? So 14% for about a month of holding a trade is not bad. And You multiply that times 12 if you were able to find a trade like this every month, and you'd be having a pretty good year. Now again, personally, I think I'd rather just do something like this and wait for this to hopefully rally up to 40, and then from there maybe sell some 40 calls, and you could pick up movement on the stock as well as the options at that point. But I think both approaches have merit to them and are worth looking at as a possible way of taking the trade. Now again, you can go through the same thing with EIX if you prefer that name. And I actually preferred PCG because I think the options gave us more choices. Because these things have gapped down so quickly, there's not a lot of strikes below 55 on EIX, and they don't have weekly options, so that we had a little bit less choice than we have with PCG. But I think both offer value. Now, again, this is the type of trade that I typically will have stuff like this, access to my earnings workshop trades, access to other specific market hedges or earnings specific, option specific plays that we will have in our patreon.com/stockdarts blog, where there will be a subscription specifically for options plays. So if you're an options trader, if you like to look for options, if you want to learn more about options, then I highly recommend you go ahead and check that out and see if you like my content. There's a lot of free content on there. There's some paid content, but you get exposure to a lot of it if you just go ahead and log in every day and go ahead and take a look at that. So that's the idea for today. Like I said, it's going to be something that I'm going to be exploring a little bit more, especially now that we're in a market that is providing us with more opportunities to look at short plays, to look at these range-bound plays, to look at some high volatility as it starts to come in across the board, and we can go ahead and take advantage of some option-specific plays that could help us deal with the behavior that we're getting out of this market. Hope you have a good rest of today, and we will see each other again in the next video.